Hello, everyone. It's a Red Monday. Let's have a great week. Hello, SH and Paul, how are you? And Sinatra, Hugo, and Brock, Alexander, my trading warrior brother. So let's take a look around, see what kind of damage is being done. So, starting off with something I've been pounding the table on for a while. If you recall, I was talking a few weeks ago about these kind of wicks in the VIX that smacked of accumulation. Then last week I said we could be carving out a right shoulder with S&Ps and NASDAQ making new highs. We didn't get close to the prior week's highs. Okay, so we'll see if we could hold this, if we get a breakout or they try and turn it back one more time. But it's either head and shoulders or descending triangle, ascending triangle, which if we start closing over that red line, looks like 28 would be the measured move there. Okay, so regarding S&Ps, and they're trying to bounce off this 200-day on the 4-hour. Let's look at the daily. So the 50 days coming in around 42.40. The key I want to mention, and I'll tell you, I doubted that it would happen for a while early in the week, but we did get a 2-week reversal in the S&Ps. This was last week's close at 43.23, and the 2-week reversal was 43.49. So if you took the signal on Friday, you have a nice lead of 41 points, even though you didn't sell the top. Okay, so, and it's still early in my view. Still think that we're going to get follow through, and I don't know why 3,900, 3,800 isn't a possibility. Also, I stayed negative the yen and put some more shorts out on this rally here, shorted it last week here, reshorted Friday here, still looking for under 108, the 108 handle, and talked about how I thought yields would sell back off and head towards this blue speed line, which we're not quite there yet. It's going to come in around 118, depends on 117. And with this going on, Dixie's making a new high. And I think one thing that changed last week, and I'm not going to chase it right here, is euro pound. I think that we could have a 2-week reversal here. So I'm open to buying a pullback, maybe around 85 and a half, 85.40, risking the lows, because if we start to penetrate this resistance, which we're attempting to do right now, I see a lot of confluence coming in right around the 88 level. Let's look at the weekly, see how these two moving averages are converging at the 88 level. I think that's viable. Of course, you have to manage the risk, and if you buy a pullback, you risk last week's low. Peter Goodburn will be joining us today. We'll ask Peter if last week's reversal week, he calls it a reversal signature, was enough to be the onset of this correction he's looking for. Stick around for this, especially if you're a commodity person. Could save you some grief over the next couple months. And with all that being said, good morning to you, Blake Morrow. How are you, buddy?
Good morning, Dale. How are you?
Good, buddy. What's new?
What's that?
What's new?
Well, this is the first time I think we've stepped in a North American trade where the S&P is down like 1%. That doesn't happen.
It's been a while. Yeah,
it has been a while. But I really want to point this out really quick. Let me just grab the charts really fast, and I think this is something that we have to obviously pay attention to. By the way, how was your weekend?
Nice. Very nice. Indoors, 6, 7 hours a day, it doesn't cool off. Last night didn't cool off hardly at all. So,
Yeah,
it's kind of an inside lifestyle.
it is this time of year when you live in the desert. It's gross. We,
Yeah.
I talk to all my friends that live in cold weather environments, and they get the same,
Yeah.
dilemma in the
In the
wintertime.
winter. Yeah.
Summertime, we just stay inside as much as possible. Anyway,
You
when I
have
was
some nice
talking,
pips. You have some nice pattern and plays working, Blake.
thank you. I'm going to be taking the Aussie off probably fairly soon. I don't know if I want to let it reach to. I mean, it'll eventually, I think, make it to 7250. But let me just kind of pull up a few things. So
Okay.
as far as the S&P goes, here's the ascending wedge. Everybody knows it's
Yeah.
kind of the ascending wedge that's working in the market right now. We are down 1%, and nearing what I think is really key support around the 72 or 72 4250 4260 level. And we're breaking through some support. And I guess the thing that we should notice, and this is where I'm going to stop here for a moment on this 4-hour chart. We are going to be making, and we already have now, depending on how far we go here, we've already made lower lows. So that's important. Okay.
Yeah.
Now we are still making higher highs. You can see how this is, let's stop here. There's a high, here's another high, right? So at this point, we're making higher highs, lower lows. So now the question will be, if we do bounce, like let's say we get
Will it be a failing rally or give us a new high?
Right. Well, are we going to do a lower high? And then if we do actually do a lower high, then I think we will break down. That would be my opinion. Maybe I'm being a little exaggerated with that line, but I don't really think I am. Sorry. I think that's going to be really key going into this next this next couple of days. I'm well. First of all, I wonder if we're going to even bounce here. So that's going to be, or where we're going to bounce from. I guess the question is going to be: do we bounce from below this trend line, so it becomes really more of a decisive breakdown today, or does it bounce from that trend line, and then we all question whether or not we're actually seeing a bearish reversal or not. So that's important. That's something that I want to talk about, or wanted to talk about. And I guess I can go reference the Aussie as well, because we did talk about this on the week ahead video just just yesterday. You guys would have seen it on yesterday on Sunday. So the Aussie continues lower. We are hitting the 161% extension. We're trading below it right now. Obviously, it's going to be down as you have the S&P, the Nasdaq, the Dow, breaking down as well. But the Aussie, has further to drop. In my opinion, I still think we are going to reach for the 7250 level. But if you don't recall our conversations from last week on the FACE webinar, I don't know. I'm pretty sure we talked about it here. It's interesting when if you're in my shoes, you do, a FACE webinar, then we do the Morning Edge webinar, which is about an hour from now. But that's exclusive to the Forex Analytics subscribers. There's some things that I'm like, most things I can say, oh, I talked about that on FACE, on our free webinars. A lot of times I'm like, did I really discuss that on the Morning Edges, or did I talk about it on the Morning Edge? Did I really mention that on FACE? And sometimes I can't remember. And this is one of those situations where anybody that's been following my analysis with Forex Analytics on a daily basis to our exclusive webinars, they know that my target is, we're in the target zone right now, because, we're in the target zone here because this is the previous target, or this is the minimum target of the triangle breakdown. This was my uh, bigger target, and actually we could probably go even further than that if we really want to. So if you take those two levels and you take us in between, you take us in between those two levels, we're already there. So we're already in like the target zone for the Aussie dollar. Even though the Aussie continues to break down here, we're really, we've already reached for it. So anyway, I think the Aussie can bounce, but that really is going to be dependent on if the S&P can find some support down here. And right now, I think the S&P has another 20 points or so before we really find out. Now we have this 200 period moving average on a 4-hour chart, but I don't think that's given us much support. If you look at previous time intervals or previous moves below that 200 period moving average, that hasn't provided a whole lot of support. So I don't think it's going to do that right now. I would be more focused on how we react down here at the 42.50 level. So again, some pretty big moves are happening overnight. We've seen, the euro. I guess I should talk about the euro as well, Dale. The euro dollar is
breaking that big trend line you showed last week.
It is, and if you were listening to the week ahead video, I even had you repeat that number back to me at 117.75. You can see we're trading below it right now. Now, just because we're trading below it doesn't mean, we're trading below it and we're breaking down. Remember, support and resistance levels is not an exact science, but when we reach for a level, like I believe this 117.75 level is so important that once we're here, you have to be paying attention. So we may be trading below 117.75. You might, some people might say, oh, we're below 117.75. I need to short it. That's never the answer for me. For me, it's like, oh, we're trading below 117.75. I need to start looking to see, are we going to close below this? Are we going to accelerate now that we've broken below it? Are we going to, bounce from these levels? This is a pivotal area in the euro. I think, if I just look at this, level as it is, a daily close below here. Yeah, I think, we get a daily close below, like, let's just say 117.75, probably 117.50. We're going to trade down towards 116 and change. Flip side is if we close back above 118 today, I wouldn't want to be on the short side either. So I think today's going to be a very pivotal day for the euro dollar, especially with the ECB later this week. So anyway, just a few things I wanted to note as we go into Monday morning here. And so Dale, what else is on your radar? What else are you looking at right now?
Well, a little surprised that there's continued, not completely, but the U.S. dollar yen looks negative to me too from last week. I thought we could see it under the 108 handle.
The guys in our chat room were just talking about the move lower in the dollar yen, but I guess what we should reference with that move lower in the dollar yen is yes. Now I'm gonna come back to this chart, so don't go anywhere with the dollar yen. Well, don't forget
that was my rationale for the short yen, as I thought that yields would take out the lows again. Yeah,
they are. And so here, if you look at the daily chart, this is the thing that we were just talking about. If you go into our here's our chat room, guys, so you can just so you guys know that, hey, we were talking about this just a few moments ago. Oh wait, hold on. Is that I want to make sure that's the room that we were talking about. That's not it. We were just talking about yields. I don't know where the. Oh, here it is.
Ryan's.
Yeah, we were just talking about yields, and then we were talking about the let me move that over. the being below the 200-day moving average in the 10-year, and notice how we're making new trend lows. Now, I would say that there's further support down here, but the fact of the matter is we're making lower highs, or excuse me, lower lows in the 10-year, and we're also breaking below this this previous support that we had referenced last week. So that's something to note as well. And I think that breakdown in yields, the rally that we're seeing here in bonds is really weighing on that yen. Now, with the dollar yen moving lower. Now, here's the one thing I want to talk about the dollar yen really quick, going back to the 4-hour chart. I'm going to stop here for a second because I just want to say that if you have yields that are hitting new trend lows, that should mean the dollar yen breaks down. Now, here's the other thing I want you to think about. How about if it doesn't? Meaning, how about if we actually, how about if you start to see yields bounce and the dollar yen, not break this support? I wouldn't want to be short then, is I guess the point I'm trying to make. If for some reason we see, bonds come back off, we see yields bounce, I wouldn't want to be on the short side of the dollar yen because that means that we're respecting this support. So use it from a correlation standpoint. I think that's the way we should look at it. But flip side to all this is, the equity markets are taking a cue off of yields. Yields are down. Stocks are weak. NASDAQ's off pretty aggressively this morning. Down 1%.
The one part of the correlation that's not holding up with the lower yen is normally that would be supportive for precious metals. And for 2 days now, it hasn't had any impact on the weakness of precious metals.
Yeah, and what also is interesting, gold was actually just bouncing when I woke up this morning. When I woke up this morning, I looked at gold and I saw gold was actually where's my gold chart here?
Back the other way.
I think I just skipped over it.
Yeah.
Okay, where is it? There it is. When I woke up this morning, we were here. I was like, oh, look at that, go. And I was thinking the exact same thing you were. Hey, there's gold firming up, and then all of a sudden, the bottom fell out of gold, which is it is interesting that we're seeing that move, Yeah. So good point. Looks like copper is also moving as well. Oh God!
This gold move is good morning, everybody. This gold move is just the classic reaction to stronger dollar. The problem there is that we're seeing inflation everywhere, and now with COVID, this Delta variant dominating now, this is giving central banks reason to kind of avoid tapering or prolong when they're going to start tapering or hiking, all of that. So we have higher inflation, and central banks kind of have a reason to wait a little bit longer. So what happens? What's your inflation hedge? That's
yeah, true.
But anyway, yeah.
Speaking of the COVID, whatever Delta variant, and I know people are like worried about it and stuff. Unless I see the death toll start to really, really rise, I think this is a gross exaggeration right now of overreaction of this Delta variant. I really don't think it's much
maybe in the U.S., Blake, but look around the world. I mean,
maybe you're right. Maybe because because of our vaccination numbers,
we're higher. And I'll tell you, Israel is the highest vaccinated country in the world, and one of their top epidemiologists said the vaccine's not going to be enough protection, and they're going to a third shot. And also, if you read, they make it sound like it's weird, rare. There are a lot of breakthrough cases of people getting it, even though they're fully vaccinated. And
but getting it is not a problem.
Yeah.
It is a problem. A lot of people, I've seen some people, read some articles, Steve, that for the person that got it, a breakthrough case, they were pretty sick. And if it was you would probably think it was a problem.
You know, well, here's the thing. Let's not get in a COVID discussion. I just think that the market's overreacting personally. Now,
Okay.
that doesn't mean it probably doesn't mean more than anything. I think what we have or it doesn't mean anything. What we should do is just pay attention to the charts really here. And I think the equity tells us where we're at. But I would say I would agree with what Dale said, that it's not as big of a deal here in the US because of our vaccination rates are so much higher than.
Yeah, but you can't claim at the same time that higher vaccination rates make it not a problem. But even if you're vaccinated, it's a problem. I mean, one of the two has to be true and the other one false.
Let me wait. Let me rephrase what I said. I don't think it's a big deal to the markets. I think the markets are overreacting. You know,
I agree with you. I'm with you.
Whether or not whatever people decide to do, you know, I mean, they're going to decide to do. I'm just saying that the markets, I think, are reacting right now, and I think they're overreacting. I don't know if the Delta variant is going to be as big of an issue, but I think the markets are reacting to. They're looking for a reason. I think when you hear like, oh, stocks are down because of the Delta variant, I think the markets, that's just journalists searching for something. I think the markets are really overbought, and we're just correcting towards trendline support, and we're still in a wedge. So I don't know if I'd get overly aggressively bearish the market yet, unless we start breaking down. I guess that's the point I'm trying to make. If that makes sense.
I agree with you, Blake.
I agree. That makes sense.
Yeah. So let's not point the finger at, just get carried away, pointing the finger. Oh, it's this because of this or that and the other thing. Look, we're really just nearing support, and we are pretty oversold as far as, you look at some of these currencies against the dollar. We've got some pretty oversold, overbought conditions with the dollar index. I do think the dollar is actually probing some pretty key resistance right now, and I think that really the catalyst that's going to drive us into this breakout, whether this breakout's going to be real or not, is going to be more a product of the ECB versus anything else. But maybe I'm wrong. We still have a few days to that, and we are before that, and we're still probing some pretty big resistance. Okay, but Steve, Stelios, Dale, yeah. So I just wanted to make a point that I think people are quick to point the finger at COVID.
There are other things, I mean, do you ever think of the narrative, guys, addressing all of you guys, that, all the Fed, the chairman and governors are saying we're in pretty good shape to start a taper at the end of the year. So is that the all clear? People were interpreting it's the all clear till, and then you could just stay long, and at the end of the year when they start the taper, then it'll be right to sell.
Yeah, and that's the other thing, really. It's probably going to be more, what the Fed's, how people view what the Fed's doing over the course of the next couple of months, really, as we head into Jackson Hole. So that next month is really going to help everybody determine whether this market's really going to come off. You pull away support from not only the Fed but other central banks too, and that's obviously going to be a problem on asset prices, and that's going to continue to give the dollar a boost, and it's probably going to weigh on yields. So Stelios, Steve, good morning, guys. What are you guys thinking here with all these moves? Now I know, Stelios, you had your opinion about gold. Steve, what are you seeing right now? What are you thinking?
First of all, we're finally getting some moves now having to do with gold, since Stelios mentioned it, and silver. I was, despite being bullish in the medium to long term, I was constantly saying that it looks to me like they want to have one more low. So I like the fact that they're attempting to do so. I would be more than happy to buy it lower, to buy them actually lower. I think in the case of silver, we can see a move even towards 23. In the case of gold, I wouldn't be surprised to see a retest of 1680. Now, having to do with risk off, as you said, I'm quite skeptical, because we're finally seeing equities trying to do some catching up with yields. But I'm extremely skeptical that this move lower in yields can continue for much longer, due to the macro conditions that prevail at the moment, which make it completely illogical for this move to continue unfolding much longer. You can have moves that don't make much sense in the short to medium term, but long term they're not sustainable. Even if we're talking about the bond market, which is obviously at a huge extent manipulating, because the biggest buyer there is central banks. So it's not a fully free market in movement, but still it has to somewhat depict, at least in direction, the underlying fundamentals. And currently what we do know as a fact is that we have inflation that's exploding higher, and theoretically speaking, the result of this seems to be that people are happy to receive even less yield. Now, there is a theory that's been going around for quite some time that says that perhaps the bond market and bond traders are front running what could be another recession if, as a response to inflation, the Fed tries to taper and raise rates. I'm not very sure I subscribe to that theory. So
if they raise rates, the bonds are not going to be rallying much from here. They can't. But
yeah, but the logic tell you is the logic of that theory is that the bond market is in essence pricing in
A recession.
two moves forward.
Yes,
Right.
But
so not the raising of rates, but what follows following that. And that's why I kind of fail to subscribe to that theory. You know what I mean? Because you suddenly have a market pricing in like let's say two parts of the cycle forward without ever having even attempted to price in anything that that precedes that. It seems too far-fetched
I
to me.
think we're getting to a point where it's going to be one of the best risk-reward trades.
I'm with you.
I think I'm looking at the Bund in particular. Remember, guys, when I was short, I shorted that what was it, 177,
and that was a wonderful short.
And I got out at 169 and changed, and I said, look, I wanted to go back to the trend line resistance, which comes in at around 177, 178, and look, we're almost there. We're getting there. So I think that's going to be a really, really good. There you go.
Yeah, one of the things that I actually noticed this last week, Stelios, is we've broken above this trend line. I was looking at this. It was actually this weekend. I'm sorry. Now I'm thinking, what day was I looking at this? Because I did the weekend analysis on the Boons, and I was looking at being above the 200-day moving average, and I took this trend line. I'm like, crap, we're going to break above that. And we are above it this morning. So you're talking from a risk reward perspective. It might be a good short pretty soon, but today it's getting a little bit of a goose as we're back above that trend line. So let me see where
I'm waiting for more like 177, 178. I think that's
that would be the 177, or really close to that would be the 618 retracement. So that makes a lot of sense there. That we might probe into that area. So interesting. We have a couple of minutes before Dale takes over, and he brings Dale. Who's coming in as your guest today?
Peter Bookvar.
No, not.
No, Peter Goodburn. Peter Goodburn.
Peter Goodburn. He's an Elliotician guy. So, and that's also he actually is really good. It's always nice to hear Peter's view on the market. So he's going to be a great interview. Dale must have stepped away for just a second before he starts. I just want to mention that, guys, if you are listening in here, maybe this is your first time, welcome. Tomorrow, we actually have some pretty big news here at Forex Analytics. We're going to be talking about something that's big for our company. So make sure you're here tomorrow, same time. So 23 and a half hours from right now. Be back here on this webinar because you'll hear what our announcement. Just want to make sure I mention that. Steve, Stelios, do you have any other last minute things that you want to mention to anybody?
I just wanted to say, before people get really excited, oh yes, market's going down, this is the beginning of the bear market. Zoom out a little bit on the chart and you'll see it's still a little blip, and with yields this low, I kind of still find it difficult to see how we're going to have a proper move lower with the yields down there. That's
Good point. And, just again, let's look at the grand scheme of things. When you say it's a little blip, I mean, this is how little of a blip it is in the grand scheme of things. And we are nearing really key levels of support here. Steve, any last minute things that you want to mention?
Any last words, Steve, before you go?
What do you want for your last meal?
Do you know something I don't?
No, I just would, this is a very important statement you make here. Go ahead.
Yes. So, listen, I've been saying that I expect some kind of a short-lived but sharp corrective move during summertime. This might be the beginning of it, but as I said before, I think whatever it is, it's going to be rather short-lived, even if this is what we're talking about. I don't really see the overall conditions having changed significantly. Having said all that, I really hope, because I think we all do, that being a Monday, this is the beginning of at least a week of volatility, because we all know that these are the type of trading conditions we want to have, right?
Yep.
I'm not that optimistic, but I really hope it's not just a one-day wonder once again, and we go back to boring markets.
From your lips.
All right. Well said, guys.
Famous last words.
Everybody else, if you're a Forex Analytics subscriber, we'll see you on the Morning Edge in 45 minutes. We're going to go through all of and Stelios, you're going to kill me here because I did not update the bias chart.
Oh.
I made it for those of you that were here on Friday. I made it. I forgot to upload it to our system, and I didn't realize till after I closed it down on my computer, because you always upload it. I'm like, dang it, I forgot to do it. But guys, we go through all the analysis of all the major currencies, all these instruments here and more in a 45 minutes if you're a Forex Analytics subscriber. So we'll see you there. Dale, have a great interview.
Okay, good hunting today, teammates. Welcome back, Peter Goodburn. How are you, my trading warrior brother?
Dale, can you hear me?
Got you, Peter. How are you?
Hey, great to be with you. Thanks, Dale. And yeah, greetings to Blake and Steve. Hi, guys.
Hey, Peter.
How you doing?
Hey, Peter.
All right.
Good.
All right, Peter. So you want to share your screen, green button on Zoom?
Yeah, let's try.
And some interesting red action that we have going on here today. So my question to you is, and you and I kind of keep in touch. I respect your work a lot, Peter, and I'm wondering if last week's reversal, where I had a 2-week reversal where I just used the close from the prior 2 weeks, and if we close underneath it, it's a 2-week reversal. Was that enough for a reversal signature? What we saw last week, considering this week's today's sell-off?
Well, I think so. First of all, I'd just like to confirm: can you see my S&P chart?
Got it.
Okay, I'm on the right screen. Okay, good. No, I think you're right. I mean, maybe we come to the same conclusion from a different angle, but from an Elliott perspective, this morning's break below the previous week's low, I think it's really important, because up until that point, last week, the rally from this 42.79.80 area, which I'm pointing to at the moment, up to the highs last week, was an intraday 5-wave pattern. Could have been the first wave of the fifth. It could have been the fifth in its completion. We wouldn't know until, of course, this morning we've broken below last week's lows, and that means that the fifth wave is pretty much intact and finishing. And that we're
so it was kind of what. I mean, it wasn't a what they call it wasn't exactly a fifth wave failure because it made a new high. Would you call that a truncated fifth, or how would you label that last rally? Just a 5, right?
Yeah, it's no truncation. You get a truncation if the fifth wave doesn't break above the third. The third wave's here,
okay,
and the fifth wave is up here. So this looks okay. So we've got, there's 2 ways. There's actually a couple of ways to count this final leg up from 40.29. You can either do it the way I've drawn it here, 1, 2, 3 for tiny fifth wave, or you can go to a diagonal and look at a rather extended fifth. In this case, this was the original targets that we had at 43.67.
Yeah.
And basis this one, it could have squeezed up a bit higher, but it hasn't. So it's fallen in between a bit, and it's breaking this residual low. But that residual low here, last week's low at 42.79 and a little bit, means that having broken that this morning, this is really decidedly bearish. So we've got to start putting on some shorts, because I think that there's no chance for this to go back any higher anymore.
Okay. All right. So after reading your recent views on the market, and I must say that you were early on the inflation reflation trade. Remember, you talked about one more break in copper and then a big move, and and everything soared. Base metals, precious metals, everything, and now you're seeing that, like everything else, nothing goes straight up or down forever without digesting gains, consolidating gains, and I think what you're looking for now with the S&Ps is very dramatic and will most likely have impact on commodities as well. So there's Peter's. This is your longer term count, which I have to say is the most bearish I've ever seen you, and I've been talking to you for over 5 years.
Yeah, I think the context here is very important, because even during last year's sell-off, during the pandemic sell-off, let's have a look at that. Here it is here. I mean, that was a hell of a drop. I mean, if I just scroll back a bit, this is an expanding flat pattern that actually goes back to the beginning of 2018, which is
okay.
Yeah. So you can see that was a pretty. Here we go, back to 2018. We had three waves down for wave A, B up and C down, and this was I mean, this is really huge. But we're talking about an even bigger decline here now, and ordinarily that wouldn't be. I would have said at the beginning of last year, when we started to signal that the markets were trending up again, that wouldn't have been an obvious aspect, because the fifth wave from last year's pandemic low, we've got a target at 5,400. Normally, you'd expect that move up to be very similar to the first wave, as an expanding impulse. And when I say an expanding impulse, what I mean by that is that you get a conventional 5-wave pattern with no overlap. One of the waves is going to extend, and that's normally the third wave, which is about 80 to 85% of the time correct. So the third wave is dimensionally a lot bigger than the first or the fifth waves. And you can see that here in the third wave of intermediate degree. We begin from this point here, back in 2011. We go all the way up to the 2018 high. And that's dimensionally a lot bigger than the first wave. And if our final forecast for the fifth, it's going to be a lot bigger than the fifth wave as well. But if you look at the subdivision in waves 1 and 3, these are expanding impulse waves. They both contain the third wave, which is extended. But here, we've got a very different makeup into the final stage of the secular bull uptrend. Because last year's advance has been so exponentially rising, that it's done so in 3 price swings. In other words, it's subdivided into 3 price swings. And that's not how the first wave of intermediate degree unfolded, neither the third wave. They all started subdividing into 5s. This one's 3s. And the only time that you ever consider a 3 price swing event like this is if it's a diagonal. So you have 2 types of impulse waves, an expanding impulse, this one, or you can actually have a diagonal impulse, which has still 5 waves, but you get lots of overlap. And the makeup of that is very interesting, because the second wave demands a very steep sell-off, a correction to the first wave. And normally the second wave is about sometimes 61.8%. I've often defaulted more recurrence at 76% retracement. And that's how we come up with this very, very deep sell-off for a diagonal second wave before it starts to build up again later. So it means a big shock. I mean, don't forget that this movement up from pandemic lows has set really big records. I think this is the 3rd biggest trajectory advance from a major low in 100 years.
Yeah, really was
Yeah.
magnificent. I was selling rallies all the way up. So,
Yeah.
Peter, let me ask you this. I know, you know, a lot of people were looking for the dollar to get a bid during risk off, but what's interesting is the dollar started advancing before we got this break in S&Ps. And your target in S&Ps, just in my imagination, I know you're looking for a higher dollar up to, yeah, there we go. It doesn't seem like it would be enough of a dollar rally to justify 2,500 in the S&Ps. So do you think that there's going to be a time frame where the S&Ps could continue to go down after this dollar rally completes? Because, you know, we're only about, you know, you know, 4 points away from that target into November. Or it just isn't going to take as much of dollar strength to generate that type of sell-off in the S&Ps.
Well,
Do you know what I'm trying to reconcile?
Well, don't worry. I've had 3 conversations with institutional clients this morning on the same subject.
Okay.
So
Yeah.
you're in good keeping with them as well,
Okay.
because they've said the same. Hey, look, you know, if we're looking at such a big sell-off in equities, yeah, well, shouldn't the dollar be a lot higher than 96 figure? Well, ordinarily it makes perfect sense to think that. I think we have to take it in stages. You know, quite often the dollar does surprise. I mean, one of the big things which I had a discussion with a major client who's running a $3 billion currency fund was back here. Well, actually, yeah, it was back here pre primary wave 2's high at 103.82. If we scroll back a little bit, this consolidation pattern was quite big relative to the preceding upswing. And this particular client said to me, "Hey, Peter, shouldn't the dollar go a lot higher after such a broad consolidation over 12 months? Shouldn't this really be breaking a lot higher? You've only got a target at 103.72, and shouldn't it, you know, once it breaks out of this consolidation pattern, shouldn't it go a lot higher?" And I said, "Well, no. Basis to fib price ratio measurements on the weeklies, it shouldn't do." And he said, so we had a big issue about that, and I'm going to show you now what resolved it. Because if we go to, you know, a longer term chart, here's the dollar going back to pre-financial crisis lows. And the reason I said 103.77 was my target.
Back.
And if we just extend this original move up like this by 61.8, this is how you project the final conclusion of that correction. Okay, so we had a target at 103, and this is the breakout area here. So strange things can happen, you know. I mean, you'd expect a consolidation pattern like that, yeah, maybe to get a lot higher. It didn't. These fib price ratios were very exact. So when we come back to look at the shorter term picture, I'm rather trusting in these fib price ratios, and then tweak it as necessary. Because, you know, conceptually, you're right. If the S&P collapses, you think the dollar should do more than 96. But there's the numbers again, and I think we have to pay attention to that first and see what develops.
That's going to be a battleground for sure.
Yes, it will. I mean, don't forget also, I've labeled this move up as a double zigzag. So you've got the first zigzag here, and I've extended that by 61.8. It's not impossible. It could extend into a triple zigzag. You know, if somewhere during the decline in the S&P over the next several months, we get a corrective upswing, which is, you know, going to happen at some point, you know, the dollar index might drop down in the next wave like this, and we'll get a third and final zigzag coming up to 100 figure or something like that. It's not impossible. Okay. You know, we don't have a crystal ball, but we can manage that pretty well, I think, along the way.
Okay. Also, along with this scenario, and, you know, I know you're an elitician, but it seems like it was really all one market since COVID. Everything went up together with the dollar going down. And now it seems like with this bear market rally in the dollar, everything's going down. It's different magnitudes and degrees. But I think showing our audience today what you think could happen to certain commodity markets might save them some heartache. And you're not saying inflation's over. You're just saying that we're entering a pause in the inflation pop, and that there could be some pretty deep corrections in the commodity markets as well.
Yeah, absolutely. I mean, one of the things which have caught, the imagination of inflationary pressures is I'm just going to show an extract of our mid-year report, and this is the inflation pop and where we are with the comparative. This is the latest PCI, which of course is one of the Fed's proxies for understanding what inflation pressures are like, and we've gone exponential here. I mean, at the beginning of the year, back in April, we were still sort of quite low, but we did expect this sort of swing up. And it's just gone exponential. I think we're going to raise this target. Here's the latest PCI reading, and 3.4%. So it's gone basically well above what the Fed had predicted basically at the end of last year. They've had to revise their numbers, of course, recently. And here we've got some real yields. But the real yield is an interesting picture because that's actually ticking down now.
Right.
We actually ticked up at the beginning of the year. That's what caught everybody's imagination. They said, well, the real yield's actually moving up now. That's inflationary. This thing is going to go berserk. But actually, we've had a pause. And I tend to think that when we take a look at some of the food prices, which are a big impact in the world for inflationary pressures, that's where everybody's going to feel it.
Right.
We can see that the oils have done, extraordinarily. They've gone really exponential. Some of the oils in the food product area, and the only thing that's dragging behind is meat, but everything else is pretty high. And this is the food and agriculture index itself, which is from the United Nations body, and you can see how it's ticking up. We've got this target at 194, so this is going to be a big push up in the next few years. So inflation pressures are still going to be with us, but we're going to be taking a little bit of a pause. And we can see that here in the DB Agricultural Fund. This is an ETF. So the upswing that we've seen since last year is probably ready to take a bit of a pause. I wasn't certain when I updated this if we get a little bit of an uptick first and then a drop, or whether it drops immediately, because I noticed that in the very intraday picture, there's a little bit of a zigzag decline down here. But anyway, these charts are in our part 2 mid-year report. Actually, I can show you details later if anybody's interested in taking a video of this. But this is just an extract. But I think that we are going to take a pause. Base metals, things like copper prices, which of course are, very, very much in the front end of our commodity research, and certainly in the markets as well, is taking a bit of a pause. So if we take a look at copper prices at the moment, if I can find the right one. Yeah, this is it. And you can see that we're in a regression point. Copper's had a very, very strong exponential rise since last year's pandemic low. And this is LME 3 months, by the way, and I use it rather than COMEX because there's no gaps for the futures market. This is a seamless 3 months deferred spot contract, if you like. So there's no gaps. Anyway, the main thing is that it's dropping down and we should have a good retracement. Somewhat limited retracement in a way. I was actually originally thinking that we might come a lot more, but if we take a look at the weekly chart on copper, you'll see that we're somewhat limited in what we can drop, because here's the first wave. This is the advance in 2016. So we can't overlap with that. If it does, then we may have to come up with a diagonal, which is a bit like the S&P's picture from the last phase. So like this, if it's a diagonal, you can actually bring this down a bit lower, not a huge amount lower.
Well, it's still 30% from the highs here, right?
Yeah, it's still a lot, but it's nothing quite as comparative to the S&P drop that I'm expecting.
Yeah, S&Ps look like they're going to have the biggest drop, but aren't there other base metals? And I'm sure our audience want to know what you're thinking in the precious metals as well during this time frame.
Well, I think gold, we've been bearish for gold and silver since last year, and the cycles were giving us a bit of a clue that for at least 12-month period, that gold and silver and all the precious metals were basically tripping down. silver's, I think a very big thing. I love trading silver. I think I've always been active in silver because I started trading this back in the late 70s, during the bunker hunt time.
Yeah.
And I was fascinated by what they were doing and the story behind their manipulations and stuff. So silver's really a big thing for me. I love it. But one of the things which, if we take a look at silver, let's just trick back and show my charts a bit here. Yeah, the thing is that silver is engaged in a triangle pattern. And it started last August back here. And we've got it as a descending type triangle. Quite uncommon, these patterns. Here's the bottom in the first drop down here at 2166. Then we come up into that February high, which was all about the Reddit users starting to push up. And then we start dropping down again. And we need to get at or close towards this 2166 area. The measurements that I've used actually come to 2174, which is pretty close. But you can see in the last couple of days, back end of last week and today again, silver's starting to accelerate down pretty hard now. And this is likely to sort of continue down, I think, for another couple of months or more. And that's a good proxy also. If you take a look at the gold-silver ratio and apply that to gold. So gold actually looks like, let's have a look, looks like this, coming down to about 1600. I think we're going to get down here before we start having to buy gold again. I think we're going to break below this March-April lows down here, and we're going to actually break those and get down in a final zigzag pattern from the June high at 1916. So if you're trading gold and silver, I think there's going to be much better opportunities to buy it. And don't forget also that, if you're trading gold and silver, just make sure that you're intraday aware of what the rhythms are moving like in the dollar, because it's pretty much dollar based at the moment. It's dollar driven. Of course, there's sometimes, one of the reasons why gold has driven up from 1750 in the last month is because you've got lower yields in treasury yields, and that's been a factor, a nice headwind. But
hasn't helped it last week and the start of this week, lower yields.
No, I think that's because we've switched more emphasis to the dollar again being strong. But those are the main drivers you've got to look for. And by the way, if you take a look at GDX, all of the miners are showing us that we've got
they were so much, they didn't respond to bullion strength for a month.
Yes. And basically don't forget, this is the August high last year, so this actually topped out exactly when bullion gold topped out. But these corrections, we've still got to get down to these numbers around about 28 on the GDX. I think that would be useful to buy down there somewhere.
Okay. One question I have, classic technical analysis would look at the descending triangle that you're showing in silver as a reversal formation or a topping formation. If we start taking out the 2160 level on a closing basis, would that trigger the formation for being bearish if we took out that support?
Well, I think probably not. No.
Okay.
Because let's have a look at.
I'm so old school, but
no, this is the slightly bigger picture. Well,
yeah. All right.
No, okay, look, no, I think it's important to differentiate between certain key points of support and resistance, whether they break and whether they mean something or not. Okay, a level today on the S&P has been broken from last week's lows. That to me is very important, but only from the perspective of the preceding pattern. Just because you're breaking a support or resistance level doesn't mean you need, look, would you have bought silver on a break above 29.86 just because it's horizontal support resistance? No, you wouldn't do.
Some did. Yeah.
Well, I'm sure some did. Yeah.
Breakout.
But I wouldn't do it. Why? Because the preceding pattern indicated that this was a corrective double zigzag. So you wouldn't be buying on a breakout. You see some double zigzags or single zigzags that lead to a result in a breakout like this are B waves of more broader patterns like a triangle or an expanding flat pattern. But you've got to know where you've come from and what broader pattern that potentially is in, whether you need to break it, buy on the breakout or not. So you've got to do a bit of homework on your Elliott to understand that, whether to buy a breakout or not. today's breakdown on the S&P is giving us the sell signal, but it wasn't overtly like this on silver. If we broke down below 2166, would that be a sell signal? No, it wouldn't, because a triangle can allow wave C to sometimes break out of the trading range slightly, as long as it doesn't collapse. I mean, so you'd have to look at the pattern and measure up and say, well, okay, we can allow a little bit more. For example, if we were to go slightly lower, what I would do would be to extend this by 61.8, and if it dried up around 2057, 2060, and the pattern looked okay, you might allow that to still maintain the uptrend. Yeah.
Getting a couple of requests that we could wrap it on your view of WTI, which had another tremendous rally. People were scarred by seeing it go negative last spring and a year ago last spring. And, I think that even you, although looking for highs in this market, it was a beast that kept grinding out new ones. And looks like we may finally have something here, right?
Well, I think so. I mean, the assumption was that even though it was grinding up, I mean, this is an incredible move up from 57.25 to this recent high, just below 77. And I've got this docked as a 3 price swing event, so it becomes wave B of an expanding flat. But I actually, rolling the clock back to March when we got here, I thought that was already hitting top at the time. I thought that the market was already starting a correction in wave X with $39 being put in, and it dropped down here and then broke the highs. And ever since then, we've been adopting this idea that maybe this is a zigzag, which it seems to be adhering to now. But the idea was that if stock markets start to turn down in a big way, which they seem to be confirming today, then oil would follow, and that seems to be
oil led it.
Also consistent.
Oil peaked first, right?
It did to some
except
extent.
for the Russell. Russell was the earliest peak of anything, I think, but oil put in a secondary high last week, a lower high. So while the S&Ps were putting in their high.
Well, that's what's been difficult this year, certainly from my Elliott perspective. We had the Nikkei 225 index in Japan top out in February. We had the Russell top out in March.
Right.
And so you had immediately sort of bearish divergences, but look how long we had to wait for the S&P to top out. We've, only had confirmation really today, and it topped out basis last week's high. So, you have
it took the Dow till last week to take out its March high.
That's right. And don't forget the dollar index bottomed in January. And I was getting already excited in January saying, well, if the dollar's bottomed, the stock markets won't be too far behind. But that we've had all these major divergences, and that's been very tricky this year, I have to say.
Yeah.
But finally, this is coming to resolve. So I think crude oil is on its way down. I think we're going to get down to $39-40, somewhere down there. So hopefully.
Well, great presentation, Peter.
Thanks.
Okay, if you want to throw up for the crypto people, your Bitcoin chart.
I mean, let's take a quick peek and see how that's doing.
And then I want you to show your website so people know how to follow you.
Great, thanks a lot. Yeah, that would be good. Well, cryptos, yeah. Well, we had a great call earlier this year. We did pick out the top pretty well because we had seen initially some declines down here in March, but we picked up the double zigzag up here, and we said, right, that's really bearish. Now I can see that we're starting to break below this 30,000. Well, it's not quite broken yet. 30,500. Let's have a look at it here. This is really, really critical. 30,549. If we break that, and you imagine it might be possible because the only reason Bitcoin is coming off is, it's all about the risk off. Then we're going to have to start looking at the final downside push with this diagonal coming back from this May high down to 26,378. So be aware that if we do take that line out, which it does look likely now, doesn't it? That we're going to end up at 26,378. We're going to have to sort of come down to these numbers, I think, before we start heading up in a bigger way. There was, sometimes, it's difficult if because Bitcoin, what fundamentals do you follow? You can't. I mean, there's very little fundamental news flow. The institutions are playing this game now, but they have very little information news. So they're all trading the tech side and the technology,
Right.
the technical analysis side. There's no, you don't know whether or not there's going to be positive correlation with stock markets, risk on and risk off. We've seen it diverge during this phase at one point, and then we had the collapse, of course, which was definitely divergent to the S&P, for example.
China banning it, I mean, that's a fundamental.
Yeah. I mean, that was a good piece of information news. But there's not day-to-day news flows like that coming out, like you would trade FX or, stock markets. So it gets a bit tricky. So I can understand why you've got to sharpen your pencil a little bit and do your work on your analysis. From an Elliott perspective, though, if we start to break that secondary low here, I think we'll come down to 26.30. So you're going to have to come out. If you're long, you're going to have to come out and you're going to have to sit tight and wait. I think there's great opportunities going forward, though. I don't think that we're in any bear market at all. I think cryptos has got a pretty bright future, and some of our long-term or longer-term stuff looks a bit like this. We're going way up. So if you want to see some of our work in a little bit more detail, then you can tap into some of our reports. For example, wavetrack.com is our main hub, and you can go here and we have some information. We just published our mid-year reports for stock indices and commodities, and they're very low-end spec price points. So I think about $48, and some of the videos are lasting up to 2.5 hours. And they've got tons of information because you can actually download the PDF reports with all the charts in. So they're great. Or if you want some shorter-term updates, go into our main page and look under subscriptions. So if you click on the subscription tab, and you can see the Elliott Wave Compass report we publish twice a week, and that's $39 a month. And you'll find all our latest Bitcoin, dollar, and stock indices in there, plus a bit of gold and silver and crude oil, of course, as well.
Thank you so much, Peter, for coming over the years and giving us your time, your most valuable currency. I appreciate it very much, my trading warrior brother.
Great.
And someone's saying Peter is definitely one of the higher caliber guests you have on DP. Great read on the market.
Well, that's great.
Okay.
Thanks a lot for that feedback.
I
nice
saw a tweet. I saw a tweet where, it's not just your forecasts. Some guy tweeted that they've learned and you've helped them develop as Elliottians with explaining your work. So that's even better.
That's good for me to know, because I'm very much in the tutorial mode, so I'd like to make sure that everybody's learning something. That's how we progress ourselves. Take self-responsibility with your trading, always, but always to do your homework well and get as much good advice as you can. And then you've got a good chance that you're going to be there consistently at the end. Great stuff.
Thank you, my trading warrior brother. Have a great week, Peter.
Thanks, Dale. Thanks to everybody. Thanks for the boys as well. Good luck with everything, and we'll speak soon, hopefully.
Yeah, we will. All right, so that's a wrap, everyone. You know how to find Peter at wavetrack.com. And we'll see everyone for Turnaround Tuesday. So don't just count your Elliott waves, count your blessings, and we'll see you all tomorrow. Thanks again, Peter. Adios.
Adios, man. Take care.